So here we go with exercise 2.3. Now, the first thing that confused me, and I sure hope that your study guides are correct and mine's the only one that's wrong, but I have a feeling that our study guides are showing 5 answers and our book is asking us to complete 10 transactions. So we're missing 5 lines. So sorry about that, but what I'll do is do the first 5 transactions and then I'll just erase those and do the next 5 transactions, because this is probably your first exercise that is maybe a little bit harder to understand. I know it was harder when I started accounting to decipher a transaction and how it would affect assets, liabilities, and owner's equity. All right, so they've done transaction 1 for us. So they are showing assets have increased and owner's equity has increased. So let's take a look at the transaction. It says the owner invested $90,000 in the business. So that would be an example of the very first thing that ever happened to start a business is the owner put $90,000 in. So obviously that is an asset, and they say just to use a plus sign for increasing and a minus sign for decreasing. And then owner's equity is the other item that is increasing. Now, every single transaction that you guys deal with has 2 pieces, and that is how in accounting we talk about balancing. Every single transaction gets recorded twice, and that's how you can double check and make sure that you have everything in order with your books. Okay, let's look at number 2. We purchased $26,700 of supplies on account. Okay, supplies, as we learned in a previous problem and as you were reading the chapter, supplies is an asset. So if you buy paper, toner, pencils, all of that stuff, and they're in your cupboard, they're worth money, so they are an asset. So we just increased our assets, and when we purchase supplies on account, that means we're not paying cash for them right now. We're going to owe that company later. So that would be a liability. So then we are increasing our liability. Now I don't want to get too math on you, but notice our equal sign. When you use this double entry system, if you're going to put an increase on one side of the equation, then you have to have an increase on the other side of the equation to make it equal. Now, looking at number 3, we purchased equipment for $21,000 in cash. So if we purchased equipment, we have increased our assets, but this time we used cash. So we're not paying for it later. We're paying for it right now, and cash is an asset. So here's an example where we're going to have our double entry on the same side of the formula. So we're increasing our equipment and we're decreasing our cash. Both are asset accounts. All right, number 4, paid $6,000 for rent in advance. This is a trick question. So when you pay for rent in advance, it is an asset. And that is because you haven't used it yet. So until the month that you're going to pay for is actually over, you haven't used up that money yet. So prepaid rent is an asset. So we're going to increase our assets, but we paid for it in cash, right? So we're going to decrease our assets as well. All right, next, number 5, we performed services for $7,800 cash. All right, so this is our first transaction where we're talking about how our business makes money. So perform the services. Let's say you are a hairdresser. You cut someone's hair. So you didn't sell them a product. Well, sometimes hairdressers sell products, but pretend you didn't. So you cut somebody's hair and you were given cash for that service. So that's performing a service. We're getting close to tax season. So if someone prepares your taxes for you, you're paying them to do a task for you. So that's performing a service. So whenever a service is performed, and we're going to do this much in our work in this textbook, that is called revenue. So we performed services for cash. So we got cash, so that's obviously going to increase our assets, and we increased our revenue under owner's equity. So we have a plus sign on this side. Now, that brings up revenue, and then I think right next in number 6 we have an expense. So owner's equity is the capital that the owner has in a business. So our very first transaction was the $90,000. So $90,000 is owner's equity. And now we've added $7,800 to our $90,000. So we've got $97,800 in owner's equity after we complete transaction number 5. All right, so under owner's equity, a subset of owner's equity is revenue and expenses. Okay, I like to just always kind of keep them in mind with owner's equity. So revenue, we usually increase, and expenses are usually a decrease. So we'll come around to more of that later. Let's go ahead with number 6 because it relates to what we're talking about right this second. So number 6 is paid $2,160 for utilities. So that would be taking away from our cash, which is an asset, and we would be decreasing our owner's equity because we're having an expense there. Okay, so now let me just grab my eraser so we can complete these. This is so dumb, I can't believe they messed up the book. Hoping yours is right and mine is wrong. Okay, so we're going to do number 7. Number 7 is perform services for $10,500 on account. This one is different than number 5 because in number 5 we received cash. In number 7 our customer is owing us $10,500. Okay, so if we performed service, we've increased our assets because even though you didn't get paid cash, they're paying you later, we still count it as an asset. So we increase our assets. I'm sorry, I put an I for increase instead of a positive. And we are also increasing our owner's equity because that was revenue. Okay, number 8. We received $6,600 from charge account customers. So those are people who didn't pay us immediately when we did something for them. So we received money from them, and that would be increasing our cash, and we would also be decreasing an asset because when we originally input the transaction, we increased our assets in an account called accounts receivable. Now they're paying us in cash, so we're going to decrease accounts receivable. Both accounts are assets. Okay, number 9, paid salaries of $4,500 to employees. Cash is how we paid, so we are going to decrease our cash account. And when we pay our employees, that's an expense. That's a salary expense. So that's going to decrease owner's equity. And last, number 10, paid $6,000 to a creditor on account. A creditor is somebody that we owe money to, so a payable account. So if we paid money, paid cash, we're going to decrease our cash account, and we're going to decrease our liability. Okay, that should take us through exercise 2.3.